Welcome students. Continuing with the another model, that is sixth model, and we are going to study about behavioral finance. What is behavioral finance and interpretation, biases, and critics. So let's begin with this. What exactly behavioral finance is? So it is a subfield of behavioral economics. Okay. So it proposes that psychological influences and biases affect the financial behaviors of investor and financial practitioner. The theory tried to explain about behavioral of the investor and due to the psychological influence and what biases he has in his mind that impact on his financial behavior, okay, of any particular investor or even a financial practitioner. So, moreover, influences and biases can be the source of explanation of all types of market anomalies and specifically market anomalies, because that is share market anomalies in the stock market, such as several rises or fall in the stock prices. So, obviously, when market moves, there will be a psychological influence and there will be a biases. Always, it will be there in the investor. So, this theory has proposed how behavioral things happens with the investors. Now, if we go with the analyzing it, the theory, so a variety of perspectives we can come to know. Stock market returns are one area of finance where psychological behaviors are often assumed to influence market outcomes and return, but there are also many different angles of for observation. Okay, so psychological behavioral, we talk so many things, how psychological things work, and especially about the investor, how he behaves. Okay, it might be and with the information, it might be how he think, how he perceives. So because of that, it he acts on the market. So the purpose of classification of behavioral finance is to help understand why people make certain financial choices and how those choices can affect markets. So it's the study is not based on how whether they are using what type of analysis the investor, but it all talk about the how he behaves and how his behavior affect the stock market. That is all about the psychological thing. So within behavioral finance, it is assumed that financial participants are not perfectly rational and self-controlled, but rather psychologically influential with somewhat normal and self-controlling tendency. So what the theory tries to explain is that, so it's not about perfectly rationalism, rational thinking, and self-control, but it's all everything is all about the psychological influence with somewhat normal. Okay, how investors thinks, that is all his psychological aspects, how he perceives. Okay, so because of that, he either sell or purchase and how he react to the particular market, that all this theory try to explain. Now the critics regarding the behavior, there are two categories of irrationalities. First, investors do not always process information correctly. So it's all depend on the experiential level of the investor and how much he knows about the market. So because of this result, incorrect probability distribution of future returns will gain, because he thinks psychologically rather than thinking rationally or evaluating rational things, taking something into consideration. So without that, using his psychological perception, so due to that, he invests. So because of this, there will be incorrect probability distribution. And coming to the second one, even when the given probability distribution of returns, investors may take inconsistent or suboptimal decision. So because of this, what happens? They have behavioral biases. So these are the two categories of irrationalities. Now, coming to the information processing critics, the first one is a forecasting error because of psychological thinking. Too much weight is placed on recent experience. Second is overconfidence of the investor. So here overestimate their abilities and the precision of their forecast. And third is the conservatism. So investors are slow to update their beliefs and under react to new information due to the conservatism. And the fourth one is sample size neglect and representativeness. So investors are too quick to infer a pattern or trend from a small sample. So these are the information processing critics which happens with the investor. Now coming to the behavioral characteristics of investors, loss aversion, anchoring, diversification, disposition effect, herding, media response, and optimum. Coming to the behavioral characteristics, the first one, loss aversion. So it's devote significant attention to the assessing risk, then assess risk tolerance at least once per year, possibly using a risk tolerance questionnaire because it's a behavioral aspect. So that's why questionnaire is used. Assess gains and losses less frequently rather than frequently, go it less frequently to go for loss aversion. And next is anchoring. So it describes the common human tendency to rely too heavily on the first piece of information offered, that is the anchor. So when making decisions, so he is not waiting for some other information. Whatever first information is received, on that basis the investor take the decision. So be aware of investment anchor that has to be taken care by the investors. Use relevant benchmark in comparing the investment portfolio. Something that has to be matched. Benchmark has to be set. Okay. When we are comparing different portfolios and combinations, be cognizant of long-term goals, not short-term fluctuations. And next to diversification, so investors should make sure he properly diversified. The whatever investment he is making, that should be properly diversified. And don't let investment options dictate the asset allocation. Okay, and work with the financial advisor to determine asset classes that will maximize return and reduce risk. So that advisory options can be taken from the consultant or a financial advisor, where to invest and how much can be diversified, which stock has to be diversified. And coming to the disposition effect, so it refers to the people tendency to hang on to losers too long, don't hang with them, and sell the winners too soon. This is what happens with the people's tendency, especially with the investors. So this allows them to enjoy the feeling of winning faster and defer the pain of loss. Next, herding. This is again the investors' very high tendency, herd behavior. Line study on the effect of herd behavior. Disappropriate flow of money into a few and 5-star rated mutual funds, and rating have a lack of predictive value. So this has to be taken care while at the investing. Now, media response. The study of the effects of news on investment decision. So two groups, one received news and one did not. So the group with no news outperformed the group that received news. Okay, you might understand that because of media, how things changes and how it affect the market also. People often feel the need to react to new information. That is the people tendency. News is often irrelevant to long-term performance, and this is often misinterpreted. So whenever a piece of information comes, it is only for the short term. So people take it to the consideration and take decision on that basis, rather thinking on the long term. So information overload can cause stress. So information should be less and it should be validated one. Now optimism. So people believe it is likely that. So good things will happen to them, bad things will happen to others. Okay, so this is all about behavioral thing, not a psychological aspect, not regarding the actual fact. So they believe others are more likely to have a heart attack and develop a cancer. So this is how optimism happens from. They believe others are less likely to become rich, become famous. So this is the optimism, and this is how the behavioral tendency happen with the investors. So this has to be again modified. Now coming to the behavioral biases, there are 4 things: narrow framing, mental accounting, regret avoidance, and prospect theory. Coming to the first one, narrow frame. So how the risk is described, risky losses versus risky gains can affect investor decision. If we take risk, obviously there will be a loss or there will be a gain, but higher the risk, higher the gain also, that we have already studied. So investing is a series of propositions, not a single event. Performing should always be viewed within the context of the total net worth and then look at long-term goals, not the short-term results. So framing should be wider rather than narrow. Mental accounting. So investor may segregate accounts or monies and take risk with their gains that they would not take with their principal. And coming to the regret avoidance, investors blame themselves more when an unconventional or risky bet turns out badly. So that this has to be avoided. So again, this is a behavioral bias. Prospect theory, conventional view, utility depends on level of wealth. Okay. Coming to the behavioral view, utility depends on changes in current wealth. So this is how the prospect theory works. So this is all about behavioral finance. You can understand.